Good morning, everyone. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation in just a moment. I want to give everybody a chance to log on, and then we will start. For those of you who have logged on, you are in mute-only mode, which means that you can hear me, but I can't hear you. If you have questions during the presentation, please make sure you type them into the question box, which is in the upper right-hand side of your screen. That way, if we do not get to your questions in time, we'll take them offline. I will be reading out the question, so if there are questions you don't want me to read out, again, if you send me an email, we will take them offline. This presentation is being recorded, so if you have to leave before the end, you can listen to it at your leisure. You will receive the link in about 24 to 48 hours. So I am going to go away here for a moment, and I'll come back and we'll start in about 90 seconds or so. Good morning, everyone. My name is Bruce Lynn. I am one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation, Modeling for Financial Success in 2025, Understanding Risk for Better Decisions. So if you have logged on, you probably know by now you are on mute-only mode, which means that you can hear me, but I can't hear you. If you have questions during the presentation, please type them into the question box, and I will read them out loud. If you have questions you do not want me to read out loud, you can send me an email. And of course, if we don't get to your questions at all, best if you do type them into the question box so we can take them offline. This presentation is being recorded, so if you have to leave, you will have access to the video and you can replay it at a future point. With that, with those administrative announcements out of the way, I want to turn this over to Lachlan Hewson, who will talk about understanding risk. Lachlan, why don't you start?
Bruce, thank you very much. So welcome everybody. I appreciate you coming and listening to this webinar. Also want to give a recognition and a thank you to both Matt and Bruce for setting this up. It's something that we've been speaking about for a little while, and their sense was that from a financial executive perspective that there would be an interest in understanding how to manage the finance function more effectively, especially in terms of risk analysis and how to make better decisions around that. As Bruce said, my name is Lachlan Hewson. I'm the founder of 4D Resources Advisory. We work with boards, executives, and investors across the broad resources business, whether that's oil and gas, renewables, mining and metals, heavy industrial, agriculture, to basically help management teams and the C-suite build better companies through upgrading the finance function with a dynamic modeling approach. And that's really what we're going to focus on today. The purpose of this webinar is to provide practical insights into how you, the listener, can better understand and manage risk to reduce the probability of business failure with all its associated professional and personal consequences. What I'm looking to do is also introduce a new way to think about the finance function to help resolve difficult problems that you may currently experience and yet feel that your current tools do not adequately allow you to understand and to resolve. And also I want to highlight how this approach to the finance function can become a source of competitive advantage for a lot of companies if you're not using it already. And so I thought I would start this webinar with a couple of comments from people you probably know very well or who have heard of to really set the scene for what we in the finance function are primarily focused on, which is really money and risk. And so the author of Secrets of the Millionaire Mind, Harv Eker, he made a comment that the single biggest difference between financial success and financial failure is how well do you manage your money. It's simple. To master money, you must manage money. And what we're going to show as part of this presentation is that managing risk better is one of the primary ways you can manage money better. Warren Buffett needs no introduction. His interpretation of risk, his definition is risk comes from not knowing what you're doing. And in many ways, the finance function today, just using Excel, finds itself at those crossroads. One of the really difficult things with Excel is because it's a static or a deterministic approach, it's really difficult, if not impossible, to really understand the likelihood of different outcomes around really critical decision-making metrics. And so what we're going to focus on is how can we get to know risk better through understanding the probabilities, the likelihoods of different outcomes. Jerome Lederer, he was the aviation safety pioneer. He has a definition of risk that to me really drives how I think about financial modeling and what we should expect from our models. Risk management is a more realistic term than safety. It implies that hazards are ever present, that they must be identified, analyzed, evaluated, and controlled or rationally accepted. And this really goes to the heart of the risk-return dynamic that drives the investment decision, the capital budgeting decision, the financing decision that we all have to deal with on a day-to-day basis. And so what we're going to really come to appreciate is that there is a tool, a simple Excel add-in, that allows us to do a much better job at identifying, analyzing, and evaluating the significant risks that we face. The problem in its essence is Excel is a 30-year-old tool. And as we mentioned previously, that drives the investment decision, capital budgeting decision, financing decision for not only millions, but trillions of dollars of capital. The good thing about Excel, the reason we use it, is it's a really helpful tool to effectively synthesize all of the data that we have into a form that will allow us to generate the outputs for the critical decision-making metrics that we have. And whether they're based around values such as NPV or IRR, maybe it's more M&A focused. And so you're thinking about accretion dilution, you're thinking about the exchange ratio. Maybe it's to do with the capital structure. And so you're thinking about the leverage metrics that we have to get right. Excel as a tool does that, but it only gives us one answer, one value per iteration. Another really interesting fact I find about Excel and how we use it in finance is effectively, in almost all instances, it's a zero sigma tool. And yet from an operational perspective, we've actually gone to a point of using Six Sigma to significantly reduce risk, to significantly reduce the cost of making mistakes. And that has played a very important role in the whole value creation process. And so I think a really important question is, how do we start to bring 3 Sigma, 6 Sigma to the finance function, given how important it is in terms of the value creation process? When we think about our financial models, to my mind, there are 3 aspects broadly broadly named, that cover so many of the inputs. And what's interesting as we think about those is that all of those inputs have variability. So if we're thinking about the strategic or the management side of the business, what strategic direction do we take our business? What's the actual scale of the opportunity, both from a risk and a return perspective, where we have different paths open to us? What's the best tool to quickly evaluate those different paths to really understand which is best? Same from a broader economic perspective and a market expectation perspective. When it comes to the operational or the asset side of the business, where engineers and geoscientists and regular scientists have used a dynamic or a probabilistic approach to their work, we still incorporate this static approach, which means we lose so much of the insight that comes from operational type models. And whether that's around product development or even production volumes, logistics, or managing the portfolio of assets, the Excel tool that we use, the regular standalone version, just doesn't give us the ability to incorporate all the big data that we need to really make better decisions. And I think that's another important point to note here, is we're in an age of big data and AI. There is so much data out there. I recently came off an S&P call, and they were talking about boards and managing the IR function. And a huge concern for them is risk. A huge concern for them is all of the data, and how do we synthesize it into a form that is readily available and makes the most sense for the users of that data. And as we think about the Excel model, that problem especially applies to finance professionals. When we get into the right-hand side of the balance sheet and we're thinking about capital structure, we're thinking about how commodity prices affect our business, inflation, variability in operating costs, capital cost, from a capital structure perspective, interest rates if we're not hedged. And so as you can see, so many of the inputs that go into our Excel model have variability. And the problem is with Excel as it is, it's a very limiting tool because we have to use rules of thumb and guesstimates around what's the right range of data to include. How do we run our sensitivity analyses to try to get a better sense for the broad range of that data? And effectively, what I've realized through a lot of my career, whether it was investment banking or corporate finance, in the finance function, we often got to the wrong answer more than we got to the right answer. And why is that? It's because when we run our sensitivities, they actually don't really provide much data. They give us a range of data points, but because we don't understand the likelihood of those data points, we're actually effectively throwing darts at a board in a lot of sense. One way to really highlight that is in the simple example on the page. There are 49 data points in that sensitivity analysis, yet I have no idea if that range is too high or too low. Is it too wide or is it too narrow? I have no idea. And so if I'm using this for critical decision-making metrics around valuation, M&A, capital raising, a leverage analysis, or trying to understand risk, I think we have to honestly ask ourselves, how valuable is this data? And more importantly, is there a better way to undertake the analysis to be able to get more insight? And that's really the primary focus of this presentation, is that there are a number of different Excel add-ins, such as at risk, crystal ball, model risk, that we can use to convert our static one input for one output Excel models into a model that, one, now incorporates a lot more relevant data, but two, gives us an output where we can now understand the likelihood of a particular outcome. The current status for most companies is the box on the left-hand side, as we've just spoken about. Again, a very limited insight into the variability of the metric that we're looking at. When we use one of these Excel add-ins, and I use the at-risk add-in, rather than just having an output cell be one data point, we can now have an output cell be a range of data points, effectively a histogram, as shown in the bottom middle graph. I'll go through in the next couple of slides how do we get to an output like that. But the really important thing to take away from this slide is that with a simple Excel add-in, we can fundamentally enhance the nature of the finance function, the nature of the financial model, because now we can incorporate more data to get better outputs, to make better decisions, because now we understand the likelihood of a potential outcome. The interesting thing about a dynamic approach to financial modeling is that the sensitivity analysis, because we've run our model based on a Monte Carlo simulation, and we may have run 30 or 40,000 iterations relative to maybe the 30 or 40 we would run for the analysis on the left-hand side, is our sensitivity analysis now comes at the push of a button. And so because all the data is now calculated, we can get sensitivity output graphs such as the spider chart on the bottom right, which gives us so much more insight than we can from our subjective guesstimate-based sensitivity analyses today. What these graphs give us is a sense for the ranking of each of the inputs. It gives us a sense for how they contribute to the underlying metric over time, from a probability or a likelihood of occurrence perspective. And so this insight, this dynamic insight from running Monte Carlo simulation in Excel, will provide an order of magnitude greater insight into the critical decision-making metrics that we need to make better decisions. The other thing about a dynamic approach to financial modeling is it's not just the inputs that are going to drive the efficacy of the model. It's also the relationships between those inputs. In Excel, we often have to make the assumption that a relationship is somewhat linear, but that's not the case. If we think about a correlation coefficient being between -1 to 1, it's possible to incorporate any of those values into our dynamic models with a simple formula. Additionally, where the inputs have a non-linear relationship, we can also take that into account using a software package like @Risk. And so what I'm hoping this page does is it gives you a sense for where we are today and the shortcomings of where we are today, and the ease of which we can make a transition to a financial model that will give us a lot more output, will give us a lot more insight. And because we're including all of our data in one model, it significantly reduces the cost and cycle time associated with that model. And so your next question should be, well, that sounds really interesting, but how do I incorporate all the variability into one data cell in Excel? I thought I could only incorporate one value. And so with the software packages, you can actually incorporate a range of values. And that can be in the form of a probability distribution function, as we see on the left, or as a time series function that we see on the right. And so then you will ask, well, where does the data come for that? Because you're right, it's still garbage in, garbage out. That this approach is not going to change that. But where does the data come from the distributions? If you're thinking about OPEX or CAPEX, and there are different levels of detail you can go to, that may come from historic data. It may come from a consulting report. It may come from analog data for what you're already using for your more static model. If we think about commodity prices or interest rates or exchange rates or inflation, if we think about asset dynamics where the value in period N is related to the value in period N plus 1, or where the seasonality, then we can use a time series. And as you can see in the right-hand graphs, and I will go into this in more detail, I'm going to open up an Excel file and go through some of this practically. We use the historical data to help understand what the best future predictor of that particular input can be. And as you can see in these two graphs, whether it's the gas price, whether it's LIBOR or now SOFR, We can incorporate all the variability into one cell for a particular period rather than having to go through and manually grind out each of those data points in model after model. The benefit of being able to incorporate data in the form of a probability distribution function or a time series means now that our output metrics are going to be shown in the form of a histogram. And that's what you're seeing on this page. 4 different histograms related to an output. And so if we're thinking about the top left-hand graph, pre-tax valuation, right? Understanding value is critical. Understanding what the appropriate value is and the risk around that is something we can't do in Excel standalone. Using a more dynamic approach to modeling, we can get that at the push of a button. If we look at the bottom left-hand graph, the investor multiple invested capital, a critical metric that investors, private equity firms look at. What we can do with this analysis is now we can understand what's the probability of getting your money back, i.e., what's the probability of a MOIC of 1? If we're going to more risk-seeking investors who maybe would like to get 4 or 5 times their money back, we can now give them the actual probability or likelihood of achieving that particular objective. If we're thinking about mergers and acquisitions, which is the top right-hand graph, we can now understand not only the probability of accretion, but also more importantly, what's the risk of dilution? What's the likelihood that the merger you're investing 6 to 12 months in actually undertaking is going to destroy shareholder value? With Excel, you can't do that. Excel standalone. With these simple Excel add-ins that run a Monte Carlo simulation, you can get all of these critical insights, quantitative insights into the decision-making metrics that drive the finance business. The bottom right-hand graph is from a leverage perspective. And so whether we're dealing with the asset portfolio, whether we're dealing with the capital structure side of the business, every output, every metric that we need insight for, we can get using this approach because it's an Excel model. Everything that you can do in Excel, you can do with these add-ins. And so I think that's given us a sense for how does the Excel model work, what's the actual process. And so I think it's really important to then have a conversation around, well, how is this practical? The finance function doesn't need any more science projects. What's really important is that we understand how can we make this approach commercial day one? How can I give insights to the C-suite, to the board that is going to help them make better decisions and also help run their business better? Mergers and acquisitions are a really critical way to grow a business. And in many ways, it's the most important event that you'll often see in the life of a company. It can be transforming or it can be incredibly destructive. The data, unfortunately, points to the latter. This chart is based on the oil and gas business, the upstream part of the business, between 2011 and 2022. It's based on 750 global transactions with a minimum of $100 million of value. That represents greater than $600 billion in value in total. And what this detail shows us is that greater than 50% of transactions destroy value. And you can go to McKinsey, you can go to the Harvard Business Review. They have similar studies for M&A more broadly and related to other industries. And the data pretty much tells us the same thing, that you have only a 1 in 4 to a 1 in 5 probability that an M&A transaction will actually create significant value. And so the question is, why is that? And a large part of the answer is because the tools that we use to get the data to make the decisions that we use don't give us the insight that we need. And so what I'm going to do is I'm going to focus on a couple of slides from a public transaction. They come out of the data in the proxy statement, just to give you a sense for how much more insight will a dynamic approach provide relative to the approach that we're actually using today. When it comes to M&A, when it comes to really any investment decision, capital budgeting decision, we look at it in terms of where does it fall from a risk return perspective. And whenever we're thinking about risk, it's really important to also understand, well, what is the return? What is the reward associated with that risk? And does it make sense? When it comes to M&A, it's really interesting that we can look at the accretion dilution ratio to understand, is this going to add value or destroy value? In this case, the data on this slide is based on a public transaction, the Cabot and Cimarex deal from 2021. The red graphs that you see, the red histograms that you see, that's the probabilistic or dynamic analysis that was taken for these calculations. And so what I'm going to do is compare and contrast the insight that comes from that relative to the data that the two advisors, JP Morgan and Tudor, Pickering, Holt, provided for their respective shareholders. If we look at the left-hand graph, JP Morgan provided an accretion estimate for Cabot shareholders of 9.1%. That was it. There was just one value that they provided. I have no idea, and nobody else did, as to whether that was too high, too low. You know, what did that data point actually mean? When we run the dynamic analysis, now we can get not only answers to that question, but also to answers to other critical questions that Excel standalone can't provide. What we actually come to understand is the median level of accretion, the P50, the median, was actually 4.5%, i.e. there's a 50% probability it could be higher or lower than 4.5%. That's half of what the JP Morgan estimate was. But at least now I have a sense for, yes, there's a 50% probability that the level of accretion is going to be somewhere around 4.5%. Could be higher or could be lower. If I look at JP Morgan's estimate of 9.1, that falls at a value of P62. And what I mean by P62 is there's a probability starts on the left-hand side at 0 in this graph and then goes to 100% on the right. And so P62 is effectively saying that there's a 62% probability it could be less or equal to 9.1. There's only a 38% probability it could be 9.1 or higher. And so now I have an insight that the estimate is towards the high end of the range. The other really critical thing is to understand what's the probability of dilution. Dilution is value destruction. That's a huge risk as you go through the M&A process. In the case of Cabot, there was a 37% probability that the transaction would be dilutive in one way or another. That's greater than a 1 in 3 chance of failure. That's something that as a board or a C-suite executive, I would have thought is really important to the decision-making process. And the reason it's important is once you understand that risk, now you can start to think about strategies to mitigate it. Are there asset strategies? Are there financial strategies? Do we hedge more? Do we get rid of unperforming assets? What else do we need to do to manage the downside risk now that we've been able to quantify it? Another interesting analysis you can do with a dynamic approach is to understand, well, what are the level of cost savings I need to get to that minimum level of accretion? And in this case, Cabot shareholders needed an after-tax PV of around 250 million for the transaction to be accretive. If we then go into the right-hand graph, and I like the compare and contrast between the two different ways the two advisors have come to calculating this really important metric. Tudor, Pickering and Holt, TPH, provided two ranges, what looks to be a low range, 2 to 14%, and a high range, 17 to 36%. However, again, I have no idea as to which range makes the most sense. I don't know if they're too high or too low. Just because somebody provides a range, effectively it's meaningless until you understand the probability or the likelihood of those values being achieved. With the dynamic valuation in the background, in the red histogram, that's what we can finally see. Interestingly, If we look at the 2 to 14%, the implied probability is 37 to 69, i.e., that range only captures roughly 30% of the potential range of accretion. The median there is 7.5, and the P50, the median level of accretion, is 6.6%. And so now we have a sense of, okay, the median is 6.6. That median is actually a pretty good estimate. However, the range is actually quite small. We're excluding 70% of all other potential values. If we look at the lower range, 17 to 36, median of 26, the implied probability of that range, P75 to P94, which is only 20% of all possible values, as it turns out, that really is towards the high end of the range. The median there of 26%, at a P89 value, there's only an 11% probability you'll hit 26% or higher, relative to the median value of 6.6. And so as you can see, once we have a dynamic analysis, once we're able to understand the likelihood of the range of values for a particular metric that we're looking at, it gives us so much more insight. This is how we understand the risk of failure. It's not beta and CAPM and WACC. It's not doing tabular forms of sensitivity analysis as you see on the right-hand side or single point estimates on the left-hand side. We have to understand the full range of values to really have a sense for what is risk, what is return, and what is the optimal strategy to achieve the best relationship between those two that we can. In this case, there's still a 31% probability of dilution, so still almost a 1 in 3 chance it could be value destructive. What's interesting though is that when it comes to the cost savings, no cost savings were required for accretion. There was 0.5% accretion, again very minimal, excluding any cost savings. And so now we have this really interesting potentially tension between two sets of shareholders, which is the Cimarex shareholders don't necessarily need cost savings, the Cabot shareholders do. That dynamic will make more sense in a couple of slides. We've done the return part of the equation. The next thing we need to understand is risk. How do we understand risk? Excel, as it stands, doesn't really give us a tool to do that. We can come up with our ranges, as we've spoken about, but that doesn't really provide a lot of insight. We can try to use comps around beta and CAPM and WACC, but that doesn't really provide much insight. The way engineers think about risk, and once we can run a Monte Carlo simulation for a finance model, now we can start to access the same risk metrics that they do. This is a really easy, simple way to fundamentally upgrade how we think about risk from a finance perspective. There are two metrics that engineers use. What's called a P90 to P10 value, which is effectively is the P90th percentile value divided by the 10th percentile value, which captures 80% of the valuation range in the distribution on that page. The other one takes into account the standard deviation. Right? Standard deviation, another great way to understand risk as we learned in statistics. But here we use the coefficient of variance, which is standard deviation divided by the mean. And so where we calculate these in a standalone case and then compare it to a pro forma case, this is a really simple, elegant way to really understand, does risk increase or decrease in this particular merger? If we look at Cabot on the right-hand side in the blue box, the P90 to P10 was 1.7, the coefficient of variance, 20%. If we look at Cimarex, P90 to P10, slightly higher at 1.8, coefficient of variance, 21.2%. And so now we have a relative sense for what is the level of variability in the Cabot and Cimarex share prices. The greater the variability, the higher the risk. The lower the variability, the lower the risk. How does that compare when we put the two companies together? The answer to that is on the left-hand side of that, on the right-hand side of the histogram, and it shows Cabot post-transaction since they were the surviving entity. The P90 to P10 drops to 1.5. The coefficient of variance drops to 15.3. And so in a really simple, elegant, easy to visualize form, we can now state that the transaction results in an average 22% decline in equity risk for Cabot and Cimarex shareholders. If you go to a proxy statement, you won't see this data point. You won't see this insight. There'll be a lot of qualitative description around where cost savings are coming from, why risk should decline, but nobody can actually measure it. It's not until we have a dynamic model with a Monte Carlo simulation that we can get these critical percentile, mean, and standard deviation numbers to really understand key risk calculations, which then help determine how does risk change standalone versus pro forma. Another really critical aspect to this analysis is the sensitivity analysis. If you remember from a couple of slides earlier when we had our tabular form of a sensitivity analysis, it showed us a range of values but no sense of the likelihood. We also had no sense if that range of values is too wide, too narrow, too high, too low. Yet when we can run a Monte Carlo simulation, all of that data for the 40 or 50,000 iterations that you run is stored. And so now you have a much better sensitivity analysis tool, which comes at the push of a button. And so if I think back to all the time I spent in banking and in the corporate world, running sensitivities again and again, there was a little bit of being an organ grinder in a sense. But the problem was that all this time got invested for no incremental insight. This is where the incremental insight really comes from, because now I can understand not only the ranking of all of the inputs that go into my model, so I don't have to decide which two I'm going to run in my regular Excel sensitivity, but it also quantifies the impact of those on the metric being reviewed, which in this case is pro forma per share value. The left side of the range is the P5 value. The right side of the range is the P95 value for each of the inputs. And so when I look at this sensitivity, there are a number of things that jump out that I could not get from my regular Excel sensitivity. This is for an oil and gas company, and so as you would expect, commodity prices play a significant role. And that's what the data shows us. The first three, the most important inputs to consider in terms of driving variability in the share price or the share value, is going to be commodity prices. The benefit of this information is now we can start to do analyses around hedging. What's the right form of hedging? Do we pay more of an option to get the upside and mitigate the downside? How do we want to change this profile relative to an almost unhedged case? If we look at the next 5 variables under the 3 commodity prices, we see they're all related to Cimarex. And so what that tells us instantly is getting the Cimarex part of this merger right is critical to driving shareholder value. That's a must. Whatever you decide around commodity prices and hedging and the capital structure, the next most important thing is getting the Cimarex part of the business humming as well as you can. If we drop down, we then see in the green box that the Cabot impact, production, CapEx, OpEx, actually has a much lower impact on upside and downside. If you remember from the accretion dilution analysis, also Cabot shareholders needed cost savings, Cimarex shareholders didn't to be accretive. In this analysis, from the fourth item up from the bottom are synergies. Synergies in this case actually don't add a lot to either the upside or the downside variability of the per share value. And so now we have an insight that we don't have from a regular Excel model, which is, cost savings are important. If you can get them, great. But don't let anything get in the way of optimizing the Cimarex performance, because that is going to have a much greater impact on the success of the transaction. If you think about this sensitivity analysis, and we'll walk through it, it gives you a sense, it gives you an order of magnitude greater insight into all of the metrics that you need to focus on. And it also helps you identify which are the most important, and so where time should be best spent in terms of how do we leverage the upside, how do we mitigate the downside, do we want to change the nature of this risk profile, and if we don't, what is the level of risk that we're taking appropriate to the return now that we have both parts of that value proposition. I'm now going to jump into the model that we used. I included these 2 pages to give you a sense for what does the drop-down menu look like for at risk. And so when you go into Excel, this is simply an Excel add-in. And so when you click on the at risk, or it could be crystal ball or model risk tab, the drop-down menu is effectively the same for all 3 softwares. And it does a number of things. It helps you define the inputs, it helps you define the outputs, and then it helps you define how many sensitivities or how many iterations you want to run as part of your analysis. And so these couple of pages, they're more for people who have an interest, who maybe haven't seen at risk before, and it'll provide a little more of an explanation for what these different icons mean. So I'm going to hit escape from the presentation. And now I'm going to go into the Excel model. Bruce, can you see that?
Yes, I can see that, yes.
Great, okay, perfect. So now that we're into Excel, I'm now in, as you can see, the ribbon up here, it has all of the regular Excel functions, and then here on the right is at risk. As we chatted about, it's a simple Excel add-in. Everything that happens within at risk is related to Excel. Formatting graphs, putting in formulas, everything that you do in Excel, you can do here. And that's what's so important about it from a finance perspective, from an uptake perspective, is if you can use Excel well, you can use at risk. And I've seen young analysts and associates who have didn't do statistics, could use Excel. I've seen them become fluent in using at risk as a risk management tool in a month of being helped, of playing with the software, of learning how to use it. So it's actually a relatively easy tool, relatively easy add-in to learn, especially given the insights that it provides. And so as you can see, if we start with our regular model, we have prices, we have exchange rates, we have production, we have operating costs, we have production, marketing costs, G&A, EBITDAX or EBITDA, taxable income, capital costs. All of the inputs that we use in our regular Excel models, we use here. And so the question is, how can we then upgrade a existing deterministic model for the critical inputs that we want to now have be dynamic? And that's actually a relatively easy thing to do, because all we do is just add in the functions that we need from at risk to convert a single input cell into a cell that holds a range of different values. I'm going to go to the prices tab. And what I want to do there is show you how easy it is to calculate inputs. So the first input we're going to look at is going to be the commodity price. So here we're looking at the gas price. How do I create a time series for a particular input using historical data? Well, it's Excel. I run my cursor across and I click on a button that says time series, and I drop down to I want to fit the data. What is that going to look like? Okay. Then I hit fit. What you now see is these are all the time series functions that I could use for the gas price. And so then the question is, how do I know which one to choose? I can use the AIC code up here. The AIC code is simply a way of helping explain how much of the variability in the data set is explained by the function. The lower the AIC code, the more of the variability is explained. And as you can see, I can choose, I can go through, and for all of these, it'll show me the time series. And then it's up to me to then look at the different time series, look at what it says about the data going into the future, and then determine which of these data sets is best to explain the input variability. Brownian motion with mean regression. In the literature, a lot of mining companies, energy companies, hedge funds use this to try to, as a proxy for understanding the future oil price, gas price movements. So let's use that. What does this data set actually mean? So the blue line is the historical data. The time series is then calculated off that data. In this particular situation, the dark gray area reflects 50% of all the values that will be generated. The light gray area of a P5 to P95, that reflects 90% of the different prices that will be generated in the different iterations. And then the red line is a sample path. So all that red line is doing is showing that for one iteration, this is the price projection I will use for natural gas. And so as you can see, it's a very dynamic way to incorporate variability in any input where a time series function makes the most sense. And then it's just a matter of simply hitting write to Excel. And now we end up with a really nice function, Brownian motion mean regression, to highlight or to be the predictive tool, the input for what a commodity price is going to be when I run my iterations using Monte Carlo simulation. Another way to get data, as we talked about, is a probability distribution. And so I wouldn't do that for commodity prices, but since we're here and it's a good data set, how do I get a PDF? I run my cursor over the data, I hit fit. Okay. Now I have a historical histogram of data, and I have a range of functions to help describe that data. As we all know, this isn't nearly enough data. Sometimes this may be all you have. And so we can then either use the AIC code to determine which probability distribution function we use, or we can go through all of the ones that the software thinks could be appropriate, incorporate that, and then and maybe in this case, the gamma distribution is the best fit for these prices. Because it's in Excel, we can actually then adjust these functions with if-then functions, if it's too high, if it's too low. So we can use the regular Excel functionality to actually ensure that whatever input we choose best reflects what we think the future is going to reflect. And so that's how we define the inputs. And I know this is a very quick run through, but hopefully it'll give you a sense for how dynamic and easy to use the software is. We hit simulate. I've already done it for this model. We can define how many iterations we use. Do we do it automatically? There's a lot of insight up here as to the Monte Carlo simulation that we run and the timeliness and the statistical integrity that we want. And so let's now go to the output. I define an output simply by clicking on this slide, on this button. And so every cell that has red shading in this particular tab is an output. Every cell that has blue shading is an input. And so it's very easy. That's not something I incorporated, that's the software. And so it's very easy to understand which of these parts of the model are your regular Excel model and which parts are the inputs and which parts are the output. And so we go here and we click on simply, let's have a look at the graph. It's a value for Cabot. And so there I have my distribution along with all of the incremental insights around this particular data set. I can look at it from a discrete perspective. I can even look at it from an S-curve perspective. And so as you can see, at the push of the button, I can get the data in whatever form that I want. If I'm looking for sensitivity analysis, I can look at, okay, the graph that you saw. What are the variables that drive inputs? What are the inputs that are going to drive the output? And what is their ranking? If I want to, instead, I can look at the regression coefficients to understand which of these is most highly related, which are least related, and what's that relationship. And so this gives us insights that, as you can see, at the push of a button, I now have an order of magnitude greater insight into really critical decision-making metrics. And then here we go into the spider chart to actually see at each level of probability from P5 to P95, what is the ranking and what is the effect of each of the inputs on the output that we're looking at. And so I think that's really it in a nutshell. I'm cognizant of time. The really good thing is that you can go to the Crystal Ball website, you can go to the at-risk website at Lumivero, you can go to Model Risk, and you're able to download trial licenses to play around with this for a 2-week period. And that's actually the best way to get a sense for how it works. But the most important learning point from this is that there are tools out there, Excel add-ins, that are completely compatible with Excel, that give us all the functionality to get the inputs and the outputs and the functions and to run the simulation and to give us the reports at the drop of a button in a way that we cannot get from Excel today. With that, I would like to come back to the presentation just to finish up. And so the question then is, well, we understand the advantages, we see the ease. Can you condense everything onto one slide if I really like the idea and I need to have something to take to a more senior decision maker? Basically, a dynamic approach to modeling, really in this day and age, big data, AI, the need to meet our ESG requirements, especially G, from a risk perspective, we need to do a better job in the finance function. Using a 30-year-old tool is no longer appropriate given the tools that are out there. And so in many ways, a dynamic approach to modeling will upgrade the weakest link in the finance function today, which is the models we use. It'll provide enhanced insights for boards, executives, and investors through incorporating and reflecting real-world data, not otherwise possible in Excel. And it will provide a greater insight into the risk-return dynamics underlying all financial and investment decisions. In essence, we're moving from throwing darts at a board to having a much more success-oriented tool to do our job as finance professionals in a way that we've never been able to do it before. And best of all, it's easy to implement, use, and trust given its integrity and compatibility with Excel. And so I think, Bruce, that's really the presentation in a nutshell. I know it's been a lot for people to take on. Hopefully receiving the slides can be a helpful way to put some more context around it, and also downloading a trial license and actually just using it and playing with it could be really advantageous. But I think with that, I'm happy to answer any questions or do whatever you think is appropriate.
All right, Lachlan, thank you very much. Now is the time for those of you who want to type in your questions to do so, and we'll take them one by one. All right, here's a question. How do you adjust for anomalies in the historical data for the time series predictions? Is that something you can adjust up front?
Yes, it is. So you can. I mean, obviously, it's still garbage in, garbage out. But yes, because your time series function is based on, as you saw, running the cursor over the data. If there are anomalies that aren't going to happen again, if there are anomalies that it's due to a recording problem or it's due to a transcribing problem, you can absolutely adjust that data because all of the data you're using is in Excel. So anything that you can change in Excel standalone, you can change for this analysis and then use whichever function is the best.
All right, here's another question. Based on the at-risk analysis overview today, would you have recommended the stock merger of the two companies?
So the advisors opined that it was fair from a financial point of view. If you look at the exchange ratio, they got it right in terms of where their medians fell out. They got it reasonably right relative to what was agreed. In terms of the strategic direction they've taken since the transaction, then they have done the right things. And so when we incorporate all the data that was in the public document, the answer would be yes to that. However, and the reason I say however is I wasn't privy to other analyses and other combinations that could have been possible, or even the decisions around staying standalone. So not being part of the whole process, I can't really say for 100%, but based on the analysis here, this was all the data supported a combination.
Okay. Here's another question. We're a private company. How would I use this data when we don't have a lot of information about risk?
So that's a really great question. And this really goes to the heart of how do you make something like this commercial day one? And so if you don't have a lot of data, but you think this could be appropriate to your business, getting analog data or consulting data for what you do could be a great first step. The other thing you can do is you can actually start to build the model and use the data that you're using in a sensitivity analysis, just using the uniform probability distribution for those inputs. And that will then give you a sense for what data do we actually need in the future. So for some companies, this can be a one-step process. For other companies, this will be a three-step process. Because just the act of starting to think about things from a dynamic modeling perspective, the relationship between the inputs, what you're actually looking to get out of your model can then facilitate a deeper conversation around, well, what information do we need to start to collect or buy or find in the public markets in terms of peers or comps that we could start to build a more dynamic data set.
Okay, we've got a few minutes left here. I don't want to stand between lunch and anyone's desire to have it. So a couple of questions, and then I think we're going to have to take the rest of them offline here. But here's a question: any insights or studies as to how these add-ins affect the outcomes of M&A decision making?
So I think there's only one study, and that was a Society of Petroleum Engineers paper I wrote last year, focused on this. So this data, this analysis comes from that paper. There aren't really any direct studies out there. If you go to the mining industry and the oil and gas business, there are a lot of good studies around using a dynamic approach to valuation in terms of making better decisions. But because this isn't an approach, a dynamic approach hasn't really been used in M&A from a public market perspective in any way. The data isn't there to do I think that's sort of a study to really dive into the numbers to understand success versus failure.
All right. And I think here's the last question of the day before we sort of wrap up. Would the use of AI models eliminate the need to use at-risk or Excel in coming up with risk-oriented models?
I think it's going to be a brave CFO or CRO who puts a black box AI model in front of his or her board in this day and age. My sense is that the finance function is conservative. The fear of some sort of a black box attribute, I think, really gets in the way of using AI as a modeling tool. I think it's a great technology to ensure that the risks are fully understood, that the data is aggregated in a way that really mirrors and mimics that variability the best. For me, at risk, crystal ball, that's a great tool for the next evolutionary step in the finance function. That's going to be the tool that starts to get us to think about things dynamically, starts to get us to upgrade our materials that go to the board, that impact the decision-making process, introduced to what is the likelihood of something, the probabilities around different outcomes, the strategies, the options that can now be incorporated into a conversation to really map the best way forward. And so I think from a modeling perspective, it's more the big data question can be answered using tools like this. And that's probably the best application currently.
Yeah, I would only add my 2 cents is that when the deal blows up, who do you blame? Blaming a black box might not be the best way to avoid liability.
And that's one of the comments that you often hear is in any sort of a model, not just deal related or financing related, but budget related, is even if models are created through AI, the human element is going to be expected to reconcile, to do a budget versus actual, to put all this analysis into it to make sure that the data that it's spitting out makes sense. And it seems as though the more you incorporate a separate intelligence into that, that takes away the opportunity for humans to do that. And I think when it comes to money and risk, especially at a board level or a C-suite level, that introduces too much uncertainty, and uncertainty is what you're trying to manage and mitigate here.
Oh, thank you very much. All right, we've sort of gone a little bit over our time, so I do want to not cut this short, but I do want to be conscious of the time. People have the rest of the day to do things. So again, Lachlan, thank you very much. And again, if you have questions, you can send them to me or you can send them to Lachlan. You have his contact information right up in front of you. And I thank you all for attending, and hopefully we'll see you again on another webinar.
Bruce, thank you very much for the opportunity.
Thank you. And with that, I'm going to close out the webinar, and we'll talk to you next time.
Thank you.